ACC Amit Kumar, and let's discuss IS2 inventories. So IS2 inventories is easy as it is similar to what we have been doing till now. We record the inventories at cost, and at the end of each year, we recognize them at lower of cost or net realizable value. So golden principle remains the same, but since it is required to be done, so I'll take you through the session. We'll discuss about what are inventories, applicability of it, how to measure cost of inventory. So in case of IS2, IS2 recommends FIFO or weighted average. LIFO is prohibited, and they are more fond of absorption costing to arrive at cost than any other costing technique, though there are latest techniques being used in the industry. But as far as financial accounting is concerned, they are more inclined towards absorption costing as a method to arrive at cost. We'll look at what constitutes cost, what all can be included as part of cost, how to determine the cost, and how to deal with interchangeable inventories. So why do we need this FIFO and weighted average? We need these FIFO and weighted average. If we're dealing with large and interchangeable inventories, we can use FIFO and weighted average to cost of products, because it will be very difficult to identify each product, pick up each product and arrive at its value and then calculate it, because we'll end up our year in only doing that. So we use measurement techniques to arrive at our cost. We'll discuss what is FIFO and weighted average, NRV, why is the need for NRV, accounting treatment, and disclosures. So inventories are held for sale in the ordinary course of business. Ordinary course of business is the business in which you are primarily dealing in to generate revenue. And either you're in the process of production or resale, you're into a retail business or into a production. If you're into production, you need to arrive at your cost through your absorption costing methods. If you're into retail, you are buying it from someone and you know the price at which you're buying, and you add up some profit margin over to it and you're selling it in the market. Either it is being consumed in the process or rendering of services. Consumed in the process means if it is a hotel industry, if there is any consumables being used every day, they are part of your inventories. You are providing these services in the form of a hotel, but you are also providing these goods which are being consumed every day as part of your services. You use them as part of your production process means you are using raw material, labor, any direct cost which is required to make that one unit which will be eligible to sell. Any cost being incurred to make it happen is included as part of cost of inventories. You capitalize all these costs and show them as part of your inventories. So IS2 says that if there's any contract work or if there is any financial instrument, like a financial instrument is again a contract between one party is willing to receive, one party is paying. There's an asset of one side and liability on another side. Contract work means, so the contract work is being taken care of by IFRS 15, revenue from contracts with customers. Earlier there used to be standard on IS 11 construction contracts, which was dealing with any such contract work. So contract work is outside the purview of it. Biological assets are outside the purview of it. They are not inventories, because biological assets, the standard on IS 41 deals with agriculture produced at the point of harvest. So till the point of harvest, the standard applicable is IS 41 till the plant is living. After the point of harvest, it becomes inventories. So the wheat plant, if the wheat plant is standing in the fields, at the point of harvest, if we value the wheat plant, it is under IS 41 agriculture. After we have converted that wheat ball into grains, those grains become inventories. So till the point of harvest, it is IS 41. After the point of harvest, it becomes IS2 inventories, and we derive its first value from IS 41 at favorable cost to sell. We'll get into more detail when I'm discussing IS 41 agriculture. For the now, simply understand that biological assets doesn't come under the purview of inventories. How to measure cost? Initially, we measure it at cost means whatever we have incurred to build up that cost. If you have purchased it or either we have self-produced it. Subsequently, we measure it at lower of cost or NRV. This is the golden principle which everyone knows. Purchase price includes all the important import duties, non-refundable taxes, transport handling charges, conversion cost, direct production cost, production overheads, joint product cost. Production overhead means it is on the basis of absorption costing, which wants full cost production method, that you need to absorb overheads into the cost of making one unit, and any cost to present the asset to its present location and condition. Borrowing cost in limited circumstances. Now there is a standard known as IS 23 borrowing cost, which says that if you are self-constructing a qualifying asset means which takes substantial period of time to get ready for its intended use or sale. If you have borrowed specifically for this qualifying asset, you can add the interest cost into the cost of making that asset. There are certain inventories also which also qualify under the borrowing cost, which takes certain period of time to get ready for its intended use or sale. Can you give me an example of inventory which takes substantial period of time to get ready for its intended use or sale, and it is very favorite among the people? People are very happy to give this example. Any inventory which takes substantial period of time to get ready for its intended use or sale. Airplanes. Yes, this is one example. But the favorite one is whiskey. That it takes 12 years of maturity, 18 years of maturity, 24 years of maturity. So if you borrowed specifically for maturing the whiskey, you can capitalize the interest cost as well. These are not included as part of your cost of inventory. Any abnormal cost, like which is not normal, any fire caught up, or these cannot be included as part of your cost of making that one unit, because these are not normal. Selling costs are excluded, that do not constitute as part of your cost of making that unit. Borrowing cost, if it is not a qualifying asset. Administrative cost and storage cost, that you're storing it for your own benefit, not, it is not necessary. Now, there's one important line which is important here is all the costs which are necessary to bring the inventories to its present location and condition are included in the cost of making inventories. All the costs which are necessary. Suppose you are making some chair and there is a paint required, and that paint requires storage of 5 days. Without that storage of 5 days, the chair would not be sold in the market, because that's the requirement, that's a mandatory process. Now, if that painting is necessary and it requires storage of 5 days, then it becomes an important and necessary component for bringing the inventories to their present location and condition. But if you paint it unnecessarily, without painting also it can be sold, and there's no demand from the customer to do so, and you're storing it purposely, or it is being stored simply because you're not being able to sell, cannot be included as part of cost of inventories, because that is not the result of making that inventory. That is the result of your administrative failure. Clear? Jackson purchased raw materials for $125,000, less a rebate of 2%. It paid 25,000 as import duty, including 10,000 towards special duty. According to local laws, it will get a credit of the amount paid towards special duty. So anything refundable, it gets excluded. While determining its customs liability, it spent $3,000 on ocean freight, clearing freight charges, 4,000 on warehouse rent, and 1,500 on watchman's salary. So you need to simply bifurcate it on the simple one line. All the costs which are necessary to bring the inventories to its present location and condition will be included. The ones which are not necessary will be excluded. Or something which is general in nature, not only specifically applicable to inventories. So purchase price less rebate, any non-refundable taxes will be deducted. 25,000 will added as import duty, but 10,000 is refundable, so reduce it, will not include it as part of cost of inventories. Ocean freight will include it because it is necessary. Clearing agent charges included. 4,000 on warehouse rent and 1,500 on watchman's salary will not be included because they are not necessary to bring the inventories to their present location and condition. These are your administration expenses. Is that clear? How to determine net cost? First thing is we take the actual cost if you are able to identify it. So even there is a method known as special identification method. Special identification method means that if there are 5 or 10 items which you can easily count, can relate to their purchase order, invoice price, payments made, you can actually arrive at the cost at which you purchased it. Other alternative techniques are if you're not able to arrive at cost through actual cost, because you use standard costing as a technique to price your product and launch it in the market. If you're into retail business, you may use retail method. The standard costing takes into account normal levels of material, labor efficiency and capacity utilization, and you arrive at a cost card. You use this cost card to calculate your cost of inventories, and on this you also add up your profit margin, and you're able to sell it in the market on day one of your business. With actual cost of what incurred in making those inventories may be available only after the end of the year, but you need to sell your product at the beginning of the year. So you may use standard cost card on the basis of your past experience to sell your products in the market and launch the product. So you know your cost according to your standard cost card as well, and you can value your inventories on the basis of your standard costing technique. If you are into departmental store, you have multiple items and you know your profit margin. If you know your profit margin, that you are earning 20% margin, the margin is always on selling price. if I'm earning 20% margin, that means out of 120 is profit, 80 is cost. Out of 4,000, 20% of 4,000, that is 800 is profit and 3,200 is cost. I can easily know what is the cost of the product by removing the margin from the selling price. I can arrive at the cost. This is known as a retail method. Reduce sales value by appropriate gross margin. We arrive at retail method. This is used by departmental stores to know the value of inventories. It is not possible to pick up each item present in the departmental store and know the price of it because it is coming in at different prices. How to deal with interchangeable inventories? Though the Parle-G factory has been shut down today, I used to take examples of Parle-G, that Parle-G is replaceable. But today I heard the news that it is going to get shut down, and they are also asking many of their employees to leave because they are not able to run their business. This is happening for the first time for Parle-G, favorite of many. So if there are 100,000 packets lying in a warehouse, coming in at different prices to the buyer who is retailing it, though the MRP is same for everyone, but the retailers get different prices at different points depending on their purchase strategies, depending on their bulk strategies.